Hey, what's going on YouTube? And welcome back to Tech Conversations. I am your host Guillermo. It is April 10th. Hope you're all having a great weekend so far. Let me know in the comment section below where you're watching this video from. Always exciting to see where all my viewers are located. So let me know down below. And in today's video, I want to talk about a very important topic, something you should know prior to trading options. And if you can fully understand what we're going to talk about here today, you will become a better options trader. So before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. I'm going to use Tesla for this video. So let's head on over to Tesla, ticker symbol TSLA. Make sure you've enabled options trading in your settings, and then we'll head on over to the options. So here's the thing, okay? Here's the thing with options, guys. An options price, which we see on the right here, an options price can be influenced by a number of different factors. These factors can either help or hurt you depending on what your position is. And so to be a great trader, a successful trader, you need to understand what all these different factors are that affect options pricing. And one of the biggest factors is what is known as the Greeks. And that's what we're going to talk about here today, the Greeks. And if we click on one of these options, for example, if I click on one of these and expand it, we can see the Greeks down here at the bottom, the Greeks, and then there's 5 underneath that. Now, if you're using the mobile application, in order to see the Greeks, when you go to buy or sell an option, you get this limit price here, and then you see this bid ask. This is a drop down, and you can click on that, and that will expand, and it'll show you what the different Greeks are. That's how you get to them on the mobile application. But we're using the desktop application. Let's go back here. And so when it comes to the Greeks, these are a set of risk measures that are named after the Greek letters that denote them. So there's 4 primary Greeks. That's going to be delta, gamma, theta, vega. And then there's rho. Rho is a Greek that people don't really talk about, people don't really worry about. I'll briefly cover it towards the end of the video. For the most part, we're going to be focusing on these first 4 Greeks here. So that being said, let's just get right into it. Let's start with the first Greek on the list here, delta. Delta is a very important Greek. Delta measures the impact of a change in the price of the stock. So basically, it's how much the options price, which is here, will increase or decrease by with a $1 change in the stock. So let me explain that with an example. Let's say Tesla, which is at $677 right now, goes up by $1 to $678. Then the price of this option will increase by whatever delta is. So if that were to happen, if Tesla price went up by $1, the new value of this option would be $15.85 plus 0.4855. In other words, $16.33. Now keep in mind, guys, that the Greeks here are shown per share. There's 100 shares in each one of these contracts. So keep that in mind. The value of this is per share. Now, if the opposite were to happen, if Tesla were to drop by $1 from $677 to $676, the value of this option would decrease by delta. So it would go $15.85 minus 0.4855, or $15.36 would be the new price of this option if Tesla were to decrease by $1 here. Now, the other thing to note here is that delta will range from -1 to 0 for puts and 0 to 1 for calls. And so the deeper in the money you go, and remember, for calls here, in the money just means where the strike price is under the share price. So the deeper in the money you go, the closer it's going to get to 1, right? So delta down here is 0.9277. The further out of the money you go, so in the opposite direction, the further up here you go, the more delta is going to get closer to 0. Okay, so that's how delta kind of works depending on if you're in the money or out of the money. And so the other way people think of delta is that it's the probability of being profitable. So delta sometimes is used to determine the likelihood of an option being in the money at expiration. So, for example, if we take a look at this option right here, delta is 0.4855. The way people sometimes like to think of this is that this has a probability of 40, this is a 48.55% chance of being in the money at expiration. Now, if we go further up here and take a look at one of these, for example, this one, delta is 0.3137. So again, the way people like to think about this is this has a 31.3% chance of being in the money at expiration. If we go all the way down here, deep in the money, where delta is getting closer to 1, delta here is 0.811. Again, the way people like to think about this is this has an 88% chance of being in the money at expiration. So it's kind of a different way to think about it as well. So that's basically how delta works there, guys. Okay, and this helps answer a question I get all the time. People ask me all the time, if I buy a call, does the share price need to go above the break-even price for me to make money? No, right? Because again, if I buy this option right now, 2 minutes later, Tesla goes up by $1, the value of this option will increase by 0.4855, meaning my total return now is $48.55. So that's how delta works. Now let's move on to the second Greek here. That's gamma. So gamma measures the rate of change in delta over time. So what we need to understand here is that the stock's price is constantly changing. This means that delta values are going to be changing as well. And so gamma is what's used to measure that rate of change. And this can give traders a better idea of what to expect in the future. So again, let's look at an example here with this exact same option. So again, let's say Tesla goes up by $1. The value of this option will go up by what delta is. But then delta is also going to change, and it's going to change by what gamma is. So if Tesla goes up by $1, delta now is going to change, and the new delta will be whatever delta was plus gamma, right? So the new delta would be 0.4855 plus 0.0092, or in other words, about 0.495. That would be your new delta. Now, similarly, if Tesla goes down by $1, again, the value of your contract will decrease by what delta is, but then delta will also change, and it's going to decrease by what gamma is in that example. So in this scenario, if Tesla drops by $1, your new delta would be your current delta minus gamma. So 0.4855 minus 0.0092, or in other words, about 0.476 would be your new delta. That's how gamma works. Again, gamma is going to measure the rate of change in delta over time. Now, one thing to note about gamma is that gamma values are highest for at the money options. At the money just means that it's basically as close to the share price as possible. And so it's highest for at the money options, and it's going to be lowest for very deep in and out of the money options. So if we go all the way down here, very deep in the money, we'll see that gamma is a lot lower, 0.0037. Similarly, if we go way far out of the money up here to a 740, for example, again, gamma is going to be a lot lower, 0.0039. That's how gamma works. And one thing to note about gamma is that high gamma values have higher risk because an unfavorable move in the stock price will have an oversized impact. So again, that's how delta and gamma work so far. Now let's move on over to the third Greek here, theta. Theta, of course, is my favorite. A lot of you who sell options, right? Theta gang, you really like theta. And here's what theta is. So theta measures the rate of time decay in the value of an option. So what we need to understand is that as time goes by, the probability of an option being profitable or in the money goes down. And so theta is going to be how much value the option will lose every day, keeping share price and implied volatility constant. So for example here, theta is negative 1.4151. What does that mean? That means if I buy this contract, and let's imagine that the share price stays about the same, implied volatility stays about the same, in one day, so if I come back tomorrow, the value of my option would have decreased by 1.4151, meaning that it would now be worth, a lot less, about 1444. And I just lost about $140 in one day just due to time decay. So again, for people who buy options, theta is a bad thing. It's not your friend. But however, if you sell options, if you sell covered calls, cash secured puts, whatever, theta is your friend, right? Time decay is great for you because the buyer just lost $141, meaning the seller just made those $141. So again, theta is going to tell us, the rate of time decay in the value of an option. Now, the thing to note about theta is that theta decay or time decay will accelerate as we get closer to the expiration date. Why? Because there's less time left to make a profit from the trade, right? If you buy an option that's 2 days away from expiring, there's a lot less time left for you to make a profit from that trade versus if you buy an option that's 2, 3, 4 weeks away, right? And so a lot of people, you may hear them say, don't buy weekly options, buy an option that's 2, 3 weeks out, give yourself enough time for the stock to move in your direction. Otherwise, your contract is just losing money due to time decay. And if we take a look here, for example, at this one again, right, theta is negative 1.41. Well, if I go to the next week's option and I take a look at the exact same strike price of 680 here, we'll see that theta in this scenario is only negative 1.08. So it's a lot less, right? And again, that's because theta gets a lot bigger the closer that we get to expiration. So we're a lot closer to April 16th than April 23. Thus, this option over here with the strike price of 680 will have a higher theta. And again, negative 1.41. So that is how theta works. Again, if you're a buyer, theta is a bad thing for you. If you're a seller, theta is a great thing for you. Now, let's move on to the next Greek here, guys. So this is Vega. So when it comes to Vega, Vega measures the risk of change in implied volatility. So kind of how we talked about Delta measuring the actual price changes, Vega focuses more on changes in expectations for future volatility. So Vega tells us approximately how much an option's price will increase or decrease by with a 1% change in implied volatility. So again, let's take a look at this option as an example here. So implied volatility for this option is 49.44%. So if, for example, in this scenario, implied volatility were to increase by 1%, the value of this contract would go up by whatever Vega is. So if this goes up by 1%, the new price would be $15.85 plus 0.3488, or in other words, $16.20. However, if implied volatility drops by 1%, the value of this contract will go down by whatever Vega is. So if implied volatility goes down by 1%, the new value of this option would be $15.85 minus 0.3488, or in other words, about $15.50. And so this answers a question again that I get all the time. I bought a call, I bought a put, the price went in the direction I wanted it to go. So if I bought a call, the price of the stock went up. However, my option still lost money. Why did that happen? A lot of the times it's because if you look at implied volatility, it's a very high. You purchase that option, the price may move in the direction you want it to move. However, implied volatility may drop 10, 20, 100% and completely crush your option. And this is something that's known as IV crush, something that you see a lot when people buy an option right before earnings. And then, the earnings happens the next day. Even if the stock moved in their direction, the value of those options lost so much money that you're still losing. And again, that's because implied volatility dropped a lot, right? Again, we're talking 50, 60, 100% sometimes. And again, every time this drops by 1%, the value of your option will go down by Vega. If it goes up by 1%, the value of this option will go up by whatever Vega is. And so higher volatility makes options more expensive since there's a greater chance of hitting the strike at some point. And so sellers benefit from drops in implied volatility. So if you sell options, one thing a lot of people like to do is find options with high implied volatility. Now, if you're a buyer, you're going to benefit from increases in implied volatility. Now, one thing to note about Vega will fall as we approach expiration. Now, finally, we have the last Greek here. Again, it's the Greek not a lot of people talk about. I really don't look at it. Nobody really looks at it. And that's rho. Rho basically just represents the rate of change in interest rates. So it measures sensitivity to interest rates. And that's really as far in it as I'm going to go, guys. Again, it's not really an important Greek. That's something that you should really take a look at much. But again, I would definitely focus on these first four. So hopefully all of that made sense, guys. Again, if you can understand how these Greeks work when you're buying an option or selling an option, and you can use them to your advantage, you will definitely become a better options trader. So if you have any questions, feel free to leave them in the comments section below. Again, check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.